What's driving markets? Welcome to Market Take. Each week, we'll bring you our insights on the latest market and economic trends that are impacting investments. I'm your host, Natalie Gill, Portfolio Strategist at the BlackRock Investment Institute. This week, we unpack the market's shifting view of winners and losers as investors increasingly price in AI-driven disruption. The recent software sell-off marks a dramatic shift in market perception around the AI narrative. The debate is no longer whether AI is real. Now, markets are increasingly pricing in its potential to disrupt entire business models. We think the sorting of winners and losers we see today reinforces AI's massive build-out and the leverage needed to finance it that's blurred the line between the micro and macro. Last year, markets debated whether AI was real. Today, markets are pricing in the effect of AI as an active threat to business models. As a result, the focus is shifting to finding companies exposed to AI disruption and sorting out the potential winners and losers. The phenomenon is rippling through sectors, but recent moves indicate that markets see software as ground zero. The change in the AI narrative is showing up in the sharp performance divergence within tech. While software providers have underperformed in the past 6 months, sectors such as semiconductors and hardware have advanced. We think we are still firmly in the AI build-out phase. Mega-cap tech companies are spending heavily on chips and power infrastructure, while indicating more to come. A key reason why we like infrastructure. What has seemingly changed is the market's focus, which is now on how adoption will translate into real revenues and profits. This search for winners and losers means it's prime time for active investing, something we emphasized in our 2026 global outlook. And while software stocks have been hard hit amid the indiscriminate sell-off, we see more nuance to the moves. Not all software companies are created equal. Companies with proprietary data or strong customer relationships could leverage the AI disruption. As the sorting process takes hold, the AI builders are locking in long-term financing to fund capital spending plans, like Alphabet's plan to offer a 100-year sterling bond. But all this corporate borrowing adds supply to bond markets that are struggling with large public deficits. Greater leverage exacerbates any upward pressure on interest rates. This pressure could cool if AI-led productivity gains help the US break out of its long-term 2% growth trend. We see a credible path for this to happen someday, but recent US jobs data does not yet show that the sectors exposed to AI are cutting hiring. These concerns keep us underweight US Treasuries. We're selective in credit, where we prefer high yield and European bonds, as AI builders have largely tapped the US investment grade market. Here's our market take. We're still in the build-out phase of the AI theme, though markets are now focused on identifying potential losers. We favor US equities, but think selectivity is crucial. We also prefer credit opportunities over long-duration US Treasuries. For details, read our weekly market commentary. Go to www.blackrock.com/weekly-commentary. Thank you for tuning in. If you've enjoyed this episode, subscribe to our Market Take wherever you get your podcasts.
This content is for informational purposes only and is not an offer or a solicitation. Reliance upon information in this material is at the sole discretion of the listener. In the UK and non-European Economic Area countries, this is authorised and regulated by the Financial Conduct Authority. In the European Economic Area, this is authorised and regulated by the Netherlands Authority for the Financial Markets. Reference to the names of each company mentioned in this communication is merely for explaining the investment strategy and should not be construed as investment advice or investment recommendation of those companies. For full disclosures, go to blackrock.com/corporate/compliance/bid-disclosures.